Hello, everybody. I'm Steve McGregor, Business Development Director at Tavistock Wealth. I'm delighted to be taking part in the third of the 2021 Q&A sessions with the investment team. Today, I'm joined by Sekar Indran, our Senior Portfolio Manager for Equities. Sekar, how are you?
I'm well, thanks, Steve. How about yourself?
I'm all right. I'm not too bad, thank you very much. I'm not long back from a rather wet and windy school run. So the kids are back at school, which is great. It feels like we've got a roadmap to start to return to normality. Family members and people in the team are all getting vaccinated. So there's an air of positivity, apart from the wet weather outside, but we'll move past that. And I understand that you're studying for some high level qualifications at the minute. So I suppose lockdown's giving you the chance to focus on that a bit.
Yeah, true. Not too many other things to do, so it's used to get head in the books.
Good. Well, hopefully the summer can bring a bit of social interaction and we can see each other. The last time that we spoke was on the 9th of November, after what was a pretty tumultuous 2020 for equity markets. I don't know whether you can just spend a couple of minutes, please, just on summarising 2020 and then letting us know how 2021 has started, please.
Yeah, so I mean, 2020 was definitely a year for the history books. It's kind of funny to think with everything that went on last year, the MSCI World started the year at record highs and it ended the year at new higher record highs. So if we cast our mind back to February when COVID-19 kind of took a grip of the world, we saw a sharp and severe correction in equity markets across the globe. The MSCI World lost over 34% in just over a month. What followed next was huge, unprecedented economic policy responses from governments and central banks across the globe, and this was led by the US. So interest rates were slashed, there were huge fiscal stimulus packages implemented. And I think it's important to put the sheer magnitude of the stimulus in the US into context, because this kind of set out the roadmap for a lot of the returns we saw for the year, with the US equity markets leading the way. So in just 3 months last year, the US increased its deficit by a greater magnitude than the last 5 recessions combined. The Fed bought more treasuries in 6 weeks than it did in 10 years under Ben Bernanke and Janet Yellen post-financial crisis. So that shows the kind of sheer magnitude of the stimulus in the US. And as a result of that policy action, we saw the S&P 500 experience its shortest bear market on record. It went on to post gains of 18.5% for the year. So it's a standout equity market in the developed market space. And another factor, another theme that played into the US's leadership in 2020 was down to the US equity market's high exposure to tech companies. So tech companies, not only do they benefit from low rate environments, they also have business models that were able to thrive during economic lockdowns. So the NASDAQ was up 45% last year. And we were overweight tech, which benefited the portfolios massively. So that kind of puts things in perspective of the gains we had there.
It really does. Sergey, you're probably going to come on to this in a minute, but you just want to pick up on a couple of things because my attention span is quite short sometimes. You talked about the US markets ending the year much higher than they started the year, but that wasn't always the case for other markets. I know in the UK, we lagged somewhat. So I'm sure you'll come on and talk about that in a minute, but if you can just touch on why that was the case. And also, when we look at what's happening in 2020, we referenced the standout performance of tech in the US, but we've seen a bit of a pare back for tech stocks recently. But I know there was some stimulation in the markets again last night with reference to tech stocks. So maybe you can just touch on those when you next go on to the next part of the narrative, if you could.
Yeah, of course. So I guess, a reason we saw the US lead other areas such as Europe and the UK was largely down to firstly, this extent of relative stimulus, but also its exposure to tech sector. So, for example, the S&P 500 has roughly a 25% allocation to the tech sector. That's also not including some of the traditional tech names that fall into other sectors like communication, such as Google and Facebook, or Amazon that falls into consumer discretionary. So that weight is actually a lot larger when we include those companies. But if we compare it to the UK, so the FTSE 100, that has a roughly 1.5% allocation to tech. So that was a large factor why we saw the FTSE 100 underperform last year. It was down roughly 11.5%, but we're seeing a reversal now. So we're seeing this rotation take place. The FTSE 100 this year is actually outperforming the S&P 500. And I'll come on to it, but we have actually opened a position in the FTSE 100, and we've gone overweight UK equities. And just, I guess, to cap off the end for 2020 in EM, the other kind of main theme was we saw those economies and countries that dealt with the pandemic most effectively being the best performers, so namely China and its neighbours Taiwan and Korea. And we've been overweight those regions, and that boosted the portfolios. I guess moving on to what you've been talking about now is the rotation and some of the previous losers becoming the new winners. That kind of the catalyst for that was actually, I think, last time we spoke. So last time we spoke was early November, and I think about 30 minutes after our Q&A, we had the announcement of Pfizer's vaccine.
So the influence we have, Sekar.
Yeah, exactly. So on the back of that, we actually saw the largest one-day outperformance of value over growth on record. It was an absolutely huge move. And that has kind of been the catalyst for the rotation we've seen. So those areas which were unloved for much of 2020, cyclical and value areas such as financials, energy, industrials, they have become the new winners as of late. And areas like tech, which benefit in low rate environments, have been underperforming. So those were the winners of 2020. But we've seen yields pick up slightly, and therefore those are the type of areas that have come under pressure. And that's kind of been the theme of 2021 so far.
So we're talking about yields. I think we shouldn't confuse ourselves with bond yields, but also with dividends. But dividend paying companies and dividend stocks suffered last year. But again, playing into the whole shift and the rotation towards value, dividend paying instruments, and certainly our Acumen income portfolio, have performed pretty well of late. I don't know whether you want to just touch on that and what the outlook and the roadmap for dividend paying stocks might be.
Yeah, so I mean, typically dividend paying stocks tend to be in more value oriented sectors such as financials, and those have been areas that are becoming loved again. So we've had a lot of companies cut dividends around March last year, but those are being reinstated. There were actually regulation around UK in the UK and the US around financials. They were not allowed to pay their dividends, but that freeze has been lifted, so they're now repaying their dividends again. So that's been a kind of boost for the sector. I guess what's interesting and what we have to bear in mind going forward is when we're seeing bond yields increase, they are now, I guess, becoming, considered as a potential alternative to dividend-paying stocks. So the question is how far is it the bond yields can tick up for them to perhaps be kind of more favourable over dividend-paying stocks, which hasn't been for much of last year.
Sure. So are you able to, you've touched on some of the areas that we've rotated into, some of the positions that we've taken, but can you summarise what our current positioning is for equities, please?
Sure. So I guess the last time we spoke, we had a kind of barbell approach to our strategy. So we had high quality growth names on one end, and then we were beginning to add more cyclical and value oriented sectors on the other. But definitely recently we've been shifting the portfolios in the direction of more value and cyclical parts of the market to be more geared to a reflationary environment, allowing us to participate in this equity rotation. So to name a few of the trades we've been making, we've gone overweight US industrials and materials. These are, again, value sectors, and they're set to benefit from large infrastructure spending in the US. We've gone overweight the US financials. So as I mentioned, US banks are now able to pay dividends again, and they're able to embark on share buybacks, which have been a benefit for the area for these stocks. Banks typically benefit in higher rate environments, particularly when there are steeper yield curves, because banks borrow at the short end and then they lend at the long end. We've also seen strong earnings from the bank sector and positive earnings revisions, and they've also performed very well in the Fed's most recent stress tests. And I touched on, we've gone overweight the UK. So we actually were underweight the UK for some time now, and that definitely benefited us versus our peer group. Because as I mentioned, the FTSE 100 was down 11.5% last year. It really was one of the laggards, but that has meant valuations are cheap, and we think it has exposure to this reflationary theme, given its exposure to miners and the commodity sphere. It should also benefit from an effective vaccine rollout. So that's another position. And in terms of what we've done in terms of to fund these positions is that we've taken profit on a number of our winners. So a number of the growth stock positions that have performed tremendously well, been on amazing runs. So out of those, we've taken profit on our S&P tech position, gains in excess of 90%. We took profit on a basket of our gaming stocks, up over 20%. We took profit on our mainland Chinese equities, up over 50%. And we also took profit on part of our China tech position, and those we booked gains of just under 60%. So we've done a lot of profit taking in areas where we think we've been on a very solid run, and perhaps could come under a bit of pressure, which we have been seeing over the past couple of weeks, and rotated into those, I guess, unloved parts of the market last year that should benefit from a higher rate environment.
Sure, thank you for that. That's really helpful. It's kind of answered some of my next questions, what's helped us and what's hurt us within the portfolios. But with respect to those positions that you've referenced, I've been talking to advisors recently about some of the changes that we've made under the bonnet with respect to our strategic review of our portfolios, and perhaps having previously been guilty of diversifying away some of those very good calls that the investment team have made. We've carried out some analysis, and you make a winning call 2/3 of the time. And so how meaningful are those positions that you've just referenced, those 20-30% gains that we've made on some of those positions? Within the Acumen portfolios now, we've concentrated them a lot more, 12-15 ETF holdings per Acumen portfolio typically. Does that move us away from having 0.5% or 1% allocation to any given ETF to maybe 5, 6, 7%? And therefore that outperformance can really be fed through to portfolio level?
Yeah, I think that's definitely the case. I think previously we perhaps had we were looking to really have a really diversified bucket of ETFs. So it meant we had perhaps some small positions that weren't really, even though they performed well, they weren't really making a difference to the bottom line and the overall performance numbers. So we've kind of taken the approach of those areas we have highest conviction in, those are the trades we're going to place. We still have to be mindful of the global equity market, so in terms of the benchmark and our peer group, and how much risk we're willing to take vis-a-vis those. So obviously we have to, everything is mapped towards that. But yeah, the position sizes in general have increased, and we have fewer number of positions. So those winning calls we have made, those ones that I've discussed, they really have benefited the portfolios, and we've seen it in the performance numbers last year and started this year.
Yeah, we certainly have. And you make a great point there about risk. In investment speak, we talk about mapping to benchmarks or keeping with the IA sector or peer group, but certainly from an advisor perspective and a client perspective, when the advisor sits down with the client and agrees to a certain level of risk, we need to make sure that we're managing the money to that mandate across the risk spectrum. So no, good point. In terms of the opportunities and the risks that we're seeing for the weeks and months ahead, we've seen a bit of a increase in volatility over the last few weeks. We've seen certain sectors of the market, such as tech, sell off a little bit. And we're looking at a bit of a disconnect, unless I'm wrong, between what's actually happening with the fundamentals and market valuations. So what risk does that present to us? What are you most concerned about at the minute? And what's driving markets to be a little bit wobbly? And then also on the flip side of that, just to end it on a positive note, what opportunities do you see for equity markets in the months ahead?
Yeah, so I think you touched on it perfectly there. So I think, yeah, markets have become disconnected from economic reality because markets tend to discount forward into the future. So, they've been looking towards this reopening trade, the idea that everyone will be back on their feet, outspending money again, companies will be generating strong profits. And therefore, we've seen equity markets return really strong numbers. But what that means is, I think a lot is riding on a successful vaccine rollout for this to come into fruition. And we have the obvious risks of potential new variants of the virus coming into play. Of course, any logistical issues with the rollout means that markets are vulnerable to a correction if those risks take place. And we have seen pockets of excess and exuberance in areas of the market, with some stocks really going through the roof and trading at very high multiples. So, and as you mentioned, they have come under pressure as of late. And I think if we do have these COVID risks come back into play, then there's scope for a much larger correction there. In terms of opportunities, I think perhaps they can be categorized into two buckets. So I guess one would be looking at those areas of the market that were unloved last year, which we have been rotating into. I think there's still areas there which to be explored. One that I like, and I think we like as a team, but still monitoring, is Japanese equities. Again, so this is a market it's one of the most cyclically geared markets in the DM space. Recent earnings have surprised massively to the upside. There have been positive earnings revisions, and the corporate governance stories in Japan has improved a lot. So that's an area we're keeping an eye on. The other area which I think there could be opportunities in the future is those long-term thematic trades that we like the look of. Again, these are growth names, but they, as you say, they've been on a very strong run. They're trading at quite rich multiples. So I think if we do see a correction and there becomes more attractive entry points, it's a case of choosing the themes that we have highest conviction in, and seeing valuations that we think are reasonable.
Thank you. So to summarise in a very simple language, not to be too concerned about recent market wobbles, but to be optimistic, yet with a mind of caution attached to it, and be mindful of the fact that there is this disconnect between the economic fundamentals and rather frothy equity markets at the minute. So perhaps the most recent sell-off, and if we're likely to see a little short one, it might be healthy for long-term growth, perhaps. So cautiously optimistic, with a diversified outlook, I suppose.
Yeah, I think that's correct. Yeah, cautiously optimistic. We want to participate in the market because there are good reasons for it to continue to march higher, given the level of stimulus and given that we are on track, hopefully for economies to reopen. But we have to be mindful that there are risks, and we have to be ready to be nimble and prudent with our investment strategies. Absolutely,
and that has been the case, certainly. Second part of last year into this year, we're doing very well. So credit to yourself and the team for that, Sekar. Really interesting, as always. Thank you very much for your time. I look forward to seeing you in person. Good luck with the studying, and thanks again. Really appreciate it.
Thank you, Steve. It's been great to talk.
Thanks, Sekar. Take care. Keep well.
You too.